Most people believe economic collapses happen suddenly. One day everything is fine, the next day the system explodes. Banks fail, markets crash, governments panic. But that belief is wrong. Economic collapses do not happen overnight. They are carefully hidden, slowly buried, and professionally disguised long before the public ever notices. And there is one accounting trick, used again and again throughout history, that makes collapsing economies look stable, right until the moment they fall apart. If you understand this trick, you will never look at government numbers, bank balance sheets, or economic recoveries the same way again. Because once you see it, you realize the collapse didn't start yesterday. It started years ago, quietly, legally, and on paper. Here's the uncomfortable truth. Economies don't fail because of one bad year. They fail because losses are hidden instead of admitted. And accounting rules make that possible. Every major economic collapse you've heard of followed the same pattern. The Great Depression, Japan's lost decade, the 2008 financial crisis, the European debt crisis, even modern inflation crises. Different countries, different systems, same invisible mechanism at work. The trick is simple in concept, devastating in impact. When losses appear, instead of recognizing them immediately, institutions spread them over time, reclassify them, delay them, or move them off the balance sheet. On paper, everything looks fine. In reality, the damage keeps compounding. Let's break this down in a way most people never hear. Imagine a bank that makes bad loans. In a healthy system, those losses are recorded immediately. Capital shrinks. Risk is reduced. Pain is felt early, but recovery is possible. But governments and central banks hate early pain. So accounting rules are adjusted, losses don't disappear, they're postponed. This is called loss deferral. It sounds technical. It sounds harmless. It is neither. When losses are deferred, banks continue operating as if they are healthy. They keep lending, they keep paying bonuses, they keep reporting profits. Meanwhile, the underlying assets are rotting. This is exactly what happened before 2008. Mortgage-backed securities were losing value, but accounting rules allowed banks to mark to model instead of mark to market. In plain English, they got to decide what their assets were worth instead of letting the market decide. The collapse didn't begin in 2008. It began the moment reality was replaced with estimates. Japan perfected this trick in the 1990s. After their asset bubble burst, Japanese banks refused to recognize bad loans. They rolled them over. They restructured them. They pretended insolvent companies were still alive. Economists later called them zombie firms. On paper, Japan avoided a collapse. In reality, growth died for decades. The economy didn't crash, it slowly suffocated. This is the hidden danger of accounting tricks. They don't create dramatic collapses, they create long, silent ones. Governments use the same methods. When debt becomes too large, instead of cutting spending or raising taxes honestly, liabilities are moved off the books. Pension obligations are underestimated. Future costs are discounted aggressively. Temporary programs become permanent without being counted as such. The numbers look responsible. The reality is fragile. This is where most people get confused. They see GDP growth, they see stock market highs, they see unemployment numbers improving, and they assume the system is strong, but those numbers are built on accounting assumptions, not cash reality. GDP itself can be inflated by debt-funded spending. Borrowed money creates growth today while creating obligations tomorrow. If future costs are ignored, today looks prosperous. This is not growth, it is borrowed time. Here's the rule collapses always follow. When accounting prioritizes stability over truth, collapse becomes inevitable. The private sector does this. The public sector does this. Even households do this. Credit cards feel painless when minimum payments hide the real cost. The pain comes later, amplified. In economic systems, that amplification is deadly. Now let's talk about why this keeps happening, even though history has proven the outcome every single time. Because admitting losses is politically expensive. It ends careers, it triggers panic, it forces accountability. So leaders choose delay, central banks choose liquidity, regulators choose flexibility. And accountants are given rules that allow time to stretch, but time doesn't heal bad economics. It concentrates it. Think of it like structural damage in a building. You can repaint the walls, you can replace the furniture, you can reassure everyone inside. But if the foundation is cracking, the longer you ignore it, the more catastrophic the collapse becomes. This is why collapses feel sudden to the public. They weren't sudden, they were concealed. The moment truth finally breaks through accounting, the system looks like it failed overnight. In reality, it was bleeding silently for years. This is the part most people miss. Transparency feels dangerous in the short term, but secrecy is lethal in the long term. Every time a government says the fundamentals are strong, while changing accounting definitions, that's a warning sign. Every time losses are labeled temporary year after year, that's a warning sign. Every time debt is rebranded instead of reduced, that's a warning sign. And this brings us to inflation. Inflation is not just a monetary phenomenon, it is also an accounting one. When debts are too large to be repaid honestly, inflation becomes the quiet solution. It reduces the real value of obligations without officially defaulting. It is a hidden write-down, paid for by savers. On paper, nothing collapses. In reality, purchasing power does. This is why inflation often follows periods of aggressive loss hiding. The system eventually needs a release valve. Inflation is socially quieter than bankruptcy. If this sounds unsettling, it should, because the same mechanics are visible today. That doesn't mean collapse is guaranteed tomorrow. It means the warning signs are structural, not emotional. The most dangerous phrase in economics is, "This time is different." Accounting tricks make every error feel unique. History proves they're not. If you want to protect yourself, the first step is awareness. Don't trust surface-level numbers. Look at incentives. Look at what's being delayed instead of resolved. Look at what's being reclassified instead of reduced. And most importantly, understand this. Economic collapses are not caused by a lack of intelligence. They are caused by the refusal to accept reality early. If you're watching this and you've never heard this explained so clearly before, that's not an accident. These topics aren't taught to the public in simple language, but once you understand them, you start seeing the patterns everywhere. This channel exists for that reason. If you value calm, honest explanations of the forces shaping the global economy, then you already know what to do. Quiet understanding is power, and silent collapse is built for people who want to see what others ignore. The next collapse won't announce itself. It never does. It will arrive dressed as stability, justified by numbers, and defended by experts. And when it finally becomes visible, most people will ask how it happened. Now you know. And once you see the accounting trick behind every collapse, you can never unsee it. There is another layer to this accounting illusion that almost no one talks about, because it exposes something uncomfortable. The system does not collapse because people lie. It collapses because the rules legally allow the truth to be delayed. When accounting standards are adjusted during crises, they are presented as emergency tools. Temporary relief. Market stabilization. But temporary rules have a habit of becoming permanent habits. Once institutions learn they can survive by postponing reality, they build entire strategies around it. This creates moral hazard. If losses can be hidden, risk increases. If consequences are delayed, behavior becomes reckless. Over time, the system forgets how to operate without distortion. This is how bubbles grow without resistance. Prices rise not because value increases, but because losses are invisible. Capital flows not to productive areas, but to places where accounting optics look good. The economy doesn't allocate resources efficiently anymore. It allocates them comfortably, and comfort is dangerous. At this stage, policymakers face a trap: reveal the truth and trigger a correction, or continue the illusion and deepen the damage. History shows they almost always choose delay, not because they are evil, but because they are human. Short-term stability wins elections. Long-term honesty does not. So the gap between reported reality and actual reality widens. This is when small shocks become catastrophic: a rate hike, a liquidity crunch, a geopolitical event. On the surface, these look like causes. In reality, they are just triggers. The real cause was years of accounting silence. This is why experts are often shocked when collapses finally happen. They were watching the numbers. They weren't watching what the numbers refused to show. And this is why understanding accounting matters more than understanding headlines. Because by the time the headlines change, the damage is already done. For individuals, this knowledge is not about panic. It's about perspective. Systems are cyclical. Illusions always expire. The goal is not to predict exact dates. The goal is to recognize patterns early enough to think independently. When you hear phrases like strong balance sheets, ask what assumptions are holding them up. When you hear temporary measures, ask how long they've already lasted. When you hear unprecedented conditions, remember that every collapse believed it was unique. This channel exists to slow things down, to remove the noise, to explain what is happening beneath the surface without fear and without hype. Because the real danger isn't collapse itself. It's being the last to understand why it happened. If you're still listening right now, it means you're not looking for comfort. You're looking for clarity. And clarity is rare when systems are built on delay. The quiet truth is this: economies don't fail loudly. They whisper warnings for years. Most people never learn to listen. Silent collapse is where those whispers are translated.